Good evening. I'm Peter Andresen of Andresen and Associates. We're fee-only investment advisors, and this is hopefully a short video discussing what happened during the first 6 months of 2022. This is a video quarterly review. We usually send one out in paper for our clients. So if you're a client, you'll be receiving this later in July as a paper version, but I thought I'd give everyone a preview because the first 6 months of 2022 were actually quite historic. Disclaimer in lawyer speak. Nobody has a crystal ball. Perfection is impossible. Investing is always a haphazard process. So just be aware and be mindful. The first 6 months of 2022 were very historic. Usually when we have a stock market correction, it happens in the latter part of the year. This time, the Wall Street Journal said the S&P 500 fell 21% through Thursday, June 30th, suffering its worst half of a year since 1970. That's the first half of the year, according to Dow Jones market data. Tech stocks are really getting hammered. The bond market delivered the worst 6 months in the history of some indexes. The Vanguard Long Treasury Fund was down 20%. Diversification did not work well. This is the third time in 72 years that cash, bonds, and stocks have all been down. Real estate hasn't started to drop, but the year's only half done. Inflation is here. Are we going to have a recession? We don't know. If we have a recession, it may last longer than we thought. It may come later than we expected. But betting on a recession right now is something that really isn't possible. We're entering the bargain zone, and that's another thing that's really changed, is that these down markets have finally given us some bargains, but they're not in mainstream stocks. They're in international stocks and in small stocks. I have already been buying a little, and you'll see that if you're my client, if you look at your portfolios. What's the timing of this downturn? I'm saying 2 to 3 years, just because that's the average, no other reason. Good news, we are back to reality. Valuation matters. Speculation does not reign anymore. Debt creation is not going off the charts. So we're back to a little bit of reality, which is a healthy and good thing. Recovery is, in my opinion, inevitable because we've always recovered from a thing like this. This is not the first time we've done this. And finally, we want some courage to get through the next 6 months or coming years. Ukraine, COVID, we don't know. Mainstream stock market is down so far this year in the last 6 months. Energy, you can look at Vanguard Energy, it was up until early June, and then it started correcting as fears of recession started to impact the market, but it's still positive for the year. I'm letting my mutual funds sort that out. They've got managers for that. I'm not really selling a lot of energy at this time. What we hold, we're continuing to hold. Stock market itself was down negative 20%, which hardly counts as a bear market. It's more like just a correction. And we've had a lot of those just intra-year. The big news, technology stocks, way down, like a bit like the year 2000. As you can see, the ARK Innovation ETF, run by Kathy Woods, famous investor in innovation, down about 65% from its high. So 65% counts as a really large bear market. The overall NASDAQ technology down 30%, which counts as a decent but not spectacular bear market. Not bargains yet. Inflation is back. As you can see on this graph, if you look to the right, that's our current inflation rate. When you get past 2020, it's not as bad as the 1940s or the 1950s or the 1970s or the right at 1980 when we tipped into Paul Volcker's recession. So it's new. We haven't seen it in 40 years, but we have historically been through this kind of thing before. Because households are awash in cash, thanks to all the stimulus, inflation may last longer than we realize. And there's a great dislocation caused by COVID and politics and other things. That's why I have not been buying a great deal in my clients' portfolios. And that includes the fear of recession, because it could get worse from here. Historically, not catastrophically, usually, but if it does get bad, it could get very bad. Now, I have been buying a little global investing, because, call it international, because international price earnings ratios are low relative to the US. That means bargains. And the dollar is relatively high compared to foreign currencies. That means you get more foreign currency per dollar. That means that now is the time to be buying internationally and take a decent position. Why are international PEs valuations so cheap? Because a recession would kick them in the head. And that's why they're cheap. They may get cheaper, but historically, buying a little is not a bad thing right now. Small stock valuations are at 20-year lows. Again, that might be for a good reason. It might be because with the coming recession, small companies are going to get hammered. However, historically, it's a decent time to buy. If 20-year lows, pretty decent, but not enthusiastically, hysterically, radically. Just start trickling money in, which is what I'm doing. Now, media is pumping the thing that these are the end of days. This is not the end of days, as far as I know. I don't know of any meteors out there. Socialism is not going to take over the universe, and neither is radical fascism. If you look at the left, you can see that 1941 to 1981 featured rising rates. Starting yield was 2%. Ending yield was 13.7 on the 10-year treasury. So yes, rising rates. Yet a 60% stock, 40% bond portfolio managed to produce an 8% annual rate of return, which is pretty darn good. And the stock market did 10.9%, but they're very different stocks. They were value stocks that could price themselves versus inflation. Inflation averaged 4.7%. Now, looking over at the right, you can see that each decade in that period of rising rates featured different investment performances. The worst was in the 1970s, which is where I am thinking we may be. That was a dire decade because it featured the 1973-1974 down market, which featured rising interest rates, very much like what we're facing now. Yet the stock market still did 5.9% without any buying of bargains. The bond market still delivered over the decade 5.4%. Inflation was 7.1%. So bonds underperformed inflation, and so did stocks. But they still got through it. Here's to the stock market. With all that in mind, quick review. This was a tough 6 months. It may stay challenging going forward. We have the courage, right? There's a possibility, a strong possibility. Most of the time, when we have rising interest rates like this, we do have a recession. The possibility is out there that we will have a recession this time. That's why those PEs are so cheap, and that's why I'm not rushing to buy too fast. The bottom of this stock market decline will be visible only in hindsight, and that's why we did not sell out. We will be 30% off that bottom before we are sure that we're not going back down again, 30%. So that's why we aren't selling out. We are doing gentle, careful buying, knowing that we can't pick the bottom. We can't pick the bottom. It's ugly. It's like catching a falling knife, but we're still going to buy a little bit now. The average time for a bear market is 2 or 3 years. So let's call it that. We're 7 months into it. Anything can change that prediction. Ukraine, the war in Ukraine, the expansion of a war, social unrest, politics, COVID, something new. So we are guesstimating 2 or 3 years. That may change, might be shorter, might be longer. But my point is that we do have time to be careful and do this right. Having said that, we are probably going to be happy we bought and stayed the course in the future. I think buying at this point will make somebody smile, let's say in 5 years or so, guesstimate, might be wrong about the exact timing. But this is that bargain we've been waiting for. So long-term plan, courage. Yes, it's tough. We can get through this. Happy 4th of July and blessings.